Good day, fellow investors. Google stock analysis. We're going to just look a little bit at what's going on with the business, make a valuation into our template. You can download this template for free in the link in the description below, and then conclude with a risk and reward investing thesis, as we have done for already a few of the top S&P 500 companies. So if you enjoyed this analysis, smash that like button. Now, if we take a look at Google stock, it did really well since the IPO in 2004, and it did especially well over the last year and a half, 2 years. It has peaked a little bit in November, but declined just 7% since then. So nothing bad there. The market cap is 1.82 trillion, the price earnings ratio is 25, in line with the market price earnings ratio, but with much faster growth from YouTube. You're watching this on YouTube, so we are all customers. And we have also discussed that it is a top position of Seth Klarman, who is one of the best value investors out there, and he still holds. If we look at his Google position, he has bought, especially over the last year, sold just a little bit to rebalance, sold a little bit, but he is still holding, which means that he likely thinks that Google is still a strong hold from that perspective. If we look at Morningstar, what do they expect? So we have a last close of 2,706, and the fair value for them is still, what's that, 25% upside, with a value of 3,600 for Google share. Plus, something to note when it comes to the stock price, they are going to do a dividend stock split, so split 1:20 by adding 19 additional shares of the dividends. It should not matter to you, but just the stock price will be 1/20th of what it is now. Plus, they are strongly doing buybacks, so they have spent 50 billion over the last year on repurchases of common stocks. That's about 2.5% buyback yield on the market capitalization. Let's discuss the business. So everything is growing really well, from cloud businesses, from YouTube, from the advertising business, even quarterly record sales for Pixel phones. So really great numbers. And of course, earnings per share almost doubled over the last year, so $112 per share in earnings. And Google is Google. They have YouTube, they have the advertisement, Google Network, they have Google Other, they have Google Cloud now, and then other crazy bets that they hope it will amount to something, but a lot of things were nothing, just a crazy bet, and now you have it like YouTube. Of course, these companies are not yet profitable, Google Cloud and the other bets, but one day are expected to be, so that's also a thesis when it comes to investing in Google. The risks are, of course, regulation. The regulators might want to hit Google, but on the other hand, Google pays the few billions of fines it gets, and then it's business as usual for Google, because at the end it's about what you want as the customer. If you go on YouTube, nobody in the regulating can tell you, oh, go somewhere else. If you Google search, nobody can tell you use something else, and that's the power that Google has. Another risk is, of course, growth size, but we have to also estimate the growth versus a price earnings ratio of 25, and can the competition really come in and take Google's business or not? When it comes to valuation, how to implement the business developments into the valuation, Morningstar sees a growth rate of 16% over the next 5 years. So if we go to our intrinsic table, you can download this for free in the link in the description below. If you want to check my premium one, you can check my stock market research platform. So Google, if we click here, I have input 112 earnings per share, and then it comes, okay, what will be the growth rate if we put 15% for the next 5 years, 10% for the subsequent 5 years, discount rate of 10%, so that's the expected return you want from investing, the terminal multiple, price earnings ratio stays as it is now, then the intrinsic value is 3,179 per share for a 10% return. Thus, Google is undervalued at current levels if they can keep the growth. If they grow at faster rates and then the terminal multiple even expands a little bit, then it is significantly undervalued. So I wouldn't be surprised if Google stock hits 4,000 in the next year or two. However, if the growth slows down, then let's say 10% and then 7%, then also the terminal multiple usually slows down, and then you have a lower return. You still make money likely in the long run, so from the current 2,700 you end up with 4,728, but that's a slower than 10% return. If the terminal multiple goes lower, then you still make a little bit of money, but it all depends on these growth rates, which are extremely hard to predict. However, Google has been growing tremendously over time, has huge free cash flows despite the big investment it does. So really great company, great investors own it, and I would say that it is a medium risk because it all depends on those growth rates, and especially depends on what kind of valuation the market will give it. If it stays on 25, you will make money. If it goes to 15, who knows what can happen. That's the risk. It's more a market risk likely for Google, of course, advertisement, competition, regulation, charging. So there will be always issues, but that's the nature of investing in businesses. So to conclude, Google, medium risk, medium reward, and it's more about how do you feel about owning a great company like Google, which is one of the best business models out there. It has a strong moat, so nothing wrong. It's unlikely that you will lose money, and that's why we have also seen Seth Klarman owning it. Not much, 6th position I think, but he is owning it. Of course, the lower the price you buy it, the better your returns will be. Thanks for watching, I'll see you in the next video.